Hello, I'm Nikki Newton, President of UMB Private Wealth Management. Welcome to the 2026 UMB Economic Outlook. I'd first like to take a moment to especially thank our clients for your continued relationship and trust, including those we welcome through the acquisition of Heartland Financial in 2025. We're excited to deliver more opportunities, advice, and guidance in support of your ongoing financial journey. In Private Wealth, we are committed to delivering the unparalleled client experience. This includes enhancing online account access and expanding our teams to support our clients' best interests in 2026 and beyond. And now, I'm pleased to introduce two of our top UMB leaders, Chief Investment Officer Eric Kelly and Director of Asset Allocation Dan Kiefer, presenting this year's Economic Outlook.
Hello, and welcome to our 2025 year in review and the 2026 economic and market outlook, which we are calling the K Factor. I'm Eric Kelly, the Chief Investment Officer of UMB, and joining me today is our Director of Asset Allocation, Portfolio Construction, and all things mentally challenging, Dan Kiefer.
Hello there.
Welcome, Dan. And no, the K Factor is not Kelly and Kiefer. There's a lot more to it than that, and we'll get into details on that in a moment. 2025 was an incredibly interesting year with lots of fireworks in DC and some pretty challenging periods for the financial markets. We had a nasty sell-off in April after the initiation of the new tariff campaign. That trend was reversed pretty quickly as it became more clear that the tariffs may not be so bad for the economy after all. And the market recovery really became turbocharged when the Fed began lowering rates again later in the summer. We even powered through the longest government shutdown in our nation's history. And by the time the dust had settled, we ended up with what was a quite strong year with great returns for the financial markets. We do have to tell you, we're recording this just before Christmas, so we don't know the final numbers for 2025. Please keep that in mind when you see our charts. Economic growth has been quite robust, quite surprisingly robust, and earnings and stock market prices have followed along. But underneath that, the strong growth numbers, the Fed is looking underneath that and grappling with some challenges. Number one, the big growth surprises we got in 2025 were driven largely by what appears to be front-running of the expected tariffs. And they're also seeing underlying issues with the labor market, which point to what is a probable soft patch headed our way in early 2026. The second thing they're dealing with is the emergence of what is being called the K-shaped economy, and what we might also call K-shaped markets at this time. We'll dive into that thesis in detail. As this illustration shows you that you're seeing here, economic growth has been driven by consumption that appears to be concentrated mostly amongst the highest income households. It's also being driven by activity, corporate capital expenditures, that is concentrated largely amongst AI-related companies. So earnings and growth and market returns are concentrated within AI-related stocks. So what we have is a bifurcation of activity between the top tier of households and the top tier of companies. Those are on the upper arm of the K, and what's happening with the rest of the pack, the lower arm of the K. We're going to unpack these factors and illustrate them for you and give you our current estimate for how the Fed will handle this situation and what it means for the economy and markets as we head into next year. And of course, we'll finish up with what it means for your financial assets and portfolios as we move forward. And we will start all this by gazing into the background factors that are in place underneath what the Fed is dealing with at this time. So Dan, why don't you start us on the background factors with this incredible deal we have with tariffs?
Yeah, tariffs that we haven't seen really since the 1920s. First thought to be hugely damaging and maybe on the balance may not be as damaging as once thought. Markets have seemingly adapted to an average weighted tariff of roughly 17%. Of course, it's going to differ tremendously by industry, depending upon where trade comes from. Markets have seemingly adjusted to a 15 to 17% average weighted tariff. Of course, that differs by industry, but what was once thought to be hugely damaging maybe is being a little bit more calmly digested by markets. The certainty of getting a number is really what calmed markets. Unfortunately, we have some level of uncertainty creeping back up as challenges to the authority to implement those tariffs is being challenged in the Supreme Court. Polymarket, which is a forecasting market, currently puts the likelihood of these tariffs actually being upheld in their current form at roughly 25%. We anticipate that some plan B will occur, and so we're not expecting this to be a removal of these tariffs, but just a change in their implementation. Of course, the thing that matters to is overall level of prices and inflation.
For sure. And this is going to happen before the end of the year, so this will have happened by the time this video comes out. But hopefully there's something like 16 or 17% still in place, and it is going to feed inflation. There's no doubt about that. That's a major background factor that the Fed and everyone else are dealing with. You know this story quite well. Inflation spiked after COVID, and it's been coming down quite nicely, but at the latter half of 2025, inflation data started to move back higher, and that is largely due to the slow implementation of the tariff program. The chart is showing you where a couple of the measures of core inflation sit, currently right around 3%. The target for the Fed is the light green line across there. The Fed has a very staunch target for inflation of 2%. So inflation is well above their target, and it is moving higher. Most forecasters believe that these inflation numbers will move higher through the first half of 2026 as the tariffs become fully implemented. That would mean core inflation figures pushing up to 3.1 or 3.2 or 3.3. But the biggest assumption of all, the Fed absolutely believes that tariff-based inflation will roll over and dissipate on its own. So they believe that these inflation data, which normally would have them raising rates in an environment like this, they believe this inflation data will crest and it'll come back down and be moving closer to their target by the end of 2026. And it will do that on its own, so that they can turn away from the inflation scare that we're having and look at the other factors that are in the economy, which are pointing towards softness. The Fed just met in early December. They cut rates one more time to 3.75% for overnight rates. The big question is, where do they go from here? They gave us some strong indicators after the December meeting, which in some respects surprised some folks. Most people believe they will cut down to something like 3.25% throughout 2026. But the Fed gathered in December. They cut rates once to 3.75. They cast a thing called a dot plot. 19 of the voting members get to make a vote on where they think rates are headed over the next year. That's what you see on your screen here. Don't try to interpret all the dots that you're looking at right now, but what you do learn from what's inside that box for 2026 is a very wide dispersion of opinions amongst the Fed members. A very, very wide dispersion of what they think they will be doing in 2026. And the summary heading into the year after a fresh Fed meeting is we got a December cut down to 3.75. That dot plot that we just looked at, it seems to indicate that there's possibly 2 cuts coming our way from the Fed in 2026. Again, that's the Fed's opinion about what will happen. Technically, if you actually apply some math to those dots, it looks like 1.5 cuts is what is embedded in the dot plots. But more interestingly, they publish what's called the Summary of Economic Projections. It's a table that anyone can look up on the internet. And the Summary of Economic Projections from the entire Fed group, the median projection for next year was 1 cut in 2026, taking rates only one more time lower to 3.5%. But the however to that is the markets are expecting 3 cuts in 2026, getting rates down lower to probably the 3% range. There is a difference between what the Fed is projecting and what the markets are expecting. Most parties everywhere agree that longer term, 2 or 3, 4 years down the road, that there was a steady state probably around 3.25. But how quickly we get there is certainly not agreed upon between the Fed and the markets. So that's an interesting background factor we have to deal with. The Fed is clearly going to look past inflation and instead focus on the softness they're seeing in the economy, which is something we will delve into in some detail here. You know, what is that softness and why do they believe the economy is soft with all the booming that's happening out there in the markets? And we'll get into that in a moment. Another background factor that we are not going to dive deeply into today, we have to mention it because someone will email us some questions if we don't, is the deficit. The deficit is always going to be a background factor for the next many years. There's many ways of looking at the deficit. You typically see charts that look like the one in front of you here, which is total debt to GDP. The debt level of our nation is very high, and it is going to move higher for quite some time. The other way of looking at it is, what is the interest expense to our government and in servicing all that debt? This is probably a more sophisticated way of looking at it. Either way you look at it, our debt burden is very high, and it's going to move higher. It's going to be in the background of every conversation that goes on, and it's going to be many years in that state. The deficit is not going to necessarily have any kind of a negative impact on our economic projections for this year or next year, but it's a long-term problem that's not going to go away. It is always going to be in the background. Another great background factor that we're all grappling with, it's a good one, these incredible market returns, Dan. Unbelievable.
Sure. Yeah, despite the song of deficits, debts, and interest rates, oh my, is what certainty and a implementation and build out of a generalized and productive technology can do for market returns. Returns to equity have been super, particularly once we got some level of certainty around the rules of the game with regards to tariffs.
Yeah, it's been a great time with these market returns being where they are, but it is a factor that Dan's going to actually unpack for us in great detail a little bit later in the presentation. So now we're getting right into the theme. What is K-shaped? What are these Ks we're talking about? What's K-shaped in our economy and the markets? What are we worried about here? And we'll start with the first one, which is the U.S. economy is quite healthy. We've had some great growth numbers in 2025, but it seems to be very concentrated at the top. And we'll unpack that and talk a little bit more about it. Here's a simple illustration of what's been going on in our economy in recent quarters. This is GDP growth rates quarterly on an annualized rate. And you'll see there the last blue bar and the first gray bar were the second and third quarters of 2025. And they were phenomenal growth numbers that showed up. Somewhat surprising, way above our normal growth rate. The green line across the middle is the 2% growth rate. That's our natural growth rate in the United States. And lo and behold, in the second and third quarter, we had blowout growth way above our normal growth rates. That's not a bad thing. However, you'll see in the first bar, it says imports. And it says that in the second bar as well. Because of the tariff program, we've learned now that this was a massive explosion of activity that took place to front run and get in front of the impending tariffs. There was a huge spike in import activity to get in front of the tariffs, and that drives up the way they calculate GDP activity. So it's not a bad thing, but it's not a sustainable thing. You'll also see in the third quarter number in the gray bar there was quite a bit of consumption that was a bit surprising. We're going to unpack that because it was interesting where the consumption was located. But what virtually everyone is certain of is what is coming next. And you'll see in the fourth quarter and then on into 2026, probably a slowdown is headed our way, where we will have a slower number for the first quarter of next year, slower than normal, well below 2%. We might even have 2 or 3 more quarters where our GDP rate has fallen down below our natural growth rate. You might call it sluggish activity. That's what the Fed is focusing on. That's what they want to address. They want to get us back on a trajectory to a steady, broad 2% growth number. That's why they want to do what they want to do. But the biggest challenge we have in the first K factor is inside of that great consumption we've had, there's a bit of a disparity inside there. And Dan, you're going to unpack some of that for us.
Sure. The K line is pretty defined here. You know, you've got the blue line, which represents the top 20% of income earners, driving a substantial portion of overall consumption growth. I mean, post-pandemic, we did have a broad-based expansion of cutely named revenge spending after being tied to our houses for so long. But after that glut came through, we're really seeing the 80% of people trying to just barely keeping up with inflation. Meanwhile, all of the growth coming from the top 20%, which is just a risk that there are fewer people. It's not as a broad expansion as we might like to see.
It's not a bad thing. But if we were orchestrating an economy, we would like to see the consumption growth be spread across the economy rather than just in the wealthiest households. So this is getting a lot of press. A lot of articles going out about this, and it is fair that the consumption growth in our economy for quite some time has been driven by the wealthiest households. It is simply a fact, and it's something the Fed would like to address. Can we see specific data supporting this? Dan and I see charts of all different types of things that prove this point out. We just happen to pull one that's easy to look at and everybody understands quite well. Look at airline traffic. This is TSA throughput. How many millions of people go through TSA each and every single day? Airline traffic has been very robust, very consistent, well above the pace that was in place before COVID. So no matter where we look, we see proof that consumption is quite robust, and airline traffic would be something that is driven a lot by the upper income brackets in our country. So the data is out there to support that all this stuff is probably true. And then as the Fed looks deeper, they know that consumption has been very strong and economic activity has been very strong. They look a little deeper and they see it might be really just concentrated amongst the wealthiest of households. And when they look at things like the labor market, which they talk about all the time, they are quite worried about the signals they're seeing within the labor market. And the most commonly quoted one, the one they're most fascinated with, is simply payroll growth. This is impacting every single person in the country, and payroll growth in the United States has looked very, very weak. The Fed talks about it all the time, and on this chart here you see the monthly path of payrolls, how many jobs are added each month in the United States. Red dotted line tells you what the average is that they like. They like to see it if we have a steady economy, 125 to 150,000 jobs a month added. On the right-hand side of the chart, you'll see here at the end of 2025, we've had a string of months where our average is very close to zero. To be adding zero payrolls on a monthly basis is a rare thing in the United States, and the Fed does not like the way this looks. That's why they're talking constantly about trouble in the labor market. This is really the chart. Now, the Fed puts it together in some other ways that are a little bit more challenging when you assemble the data in a different way. If you take this monthly payroll data and you turn it into annualized changes to payrolls, this is that same data, but it's what is the annual growth rate of payrolls. And the vertical gray bars on this chart are periods of recession. And you start to uncover things like we're at below a 1% annualized growth in payrolls right now on the right-hand side of the chart. Almost certain that number is going to push even lower over the next couple of months. And typically, we've only been below 1% payroll growth in the United States on an annualized basis when we have been in a recession. That does not mean that we are in a recession now. It tells you that our labor market is quite weak. And this is something the Fed's very focused on. That's why they want to cut rates and not worry about inflation. They're worried about the labor market. They want to do something to stimulate activity to help improve some of this data that you're seeing right here. It's kind of an odd point to make. What has not happened along with this is a big spike in unemployment. Typically when payrolls collapse, jobless claims spike. This is a chart of jobless claims, and you can see on here they have not spiked real dramatically. They're just moving along in a normal channel. This is one of the things that has the Fed a little bit befuddled. There's a large group of economists that think that the jobless claims are simply delayed and that we're heading into a period where the jobless claims are going to climb. The Fed does not want to wait to see if that happens. They see what's happening with the payrolls, and they've chosen to be proactive so that we do not experience a major spike in jobless claims. The Fed wants to move ahead and be proactive, and that's certainly the message they're sending to everybody. We have to look further. We don't want to just take any one particular variable and say, that's it, that's all we need to know. And one of the things we have to look at to see is there distress in the bottom half of our economy. Is there distress there? And certainly consumer delinquencies is an important one. And the charts are interesting, Dan. Why don't you run us through it?
Yes, I mean, certainly there is stress somewhere when you're having loans that are falling delinquent. However, as we were talking about just not too long ago, the prices of autos has really changed the auto market from when a lot of these loans were likely originated, right? So you think about the time following the pandemic when autos were in short supply, you couldn't build them, and prices were insane. This could be a little bit of a follow-on to what happened in 2008 when housing prices fell. People just sort of turning in the keys to the car because they're underwater against the loan.
Yeah, and the delinquencies, again, the auto chart in particular, it looks just like it did in 2008. This does not mean we're in a recession, but it means we have to pay attention.
Yep.
Right? The spike here is something we can't simply ignore. It tells us there is some stress in the system, probably particularly on the lower end. Last but not least in this section, what are households saying about themselves? We look at a lot of data, we make some deductions from it, but what are they saying about themselves? There's a ton of surveys where they ask the average household how they feel about many, many things. University of Michigan does a lot of those. And one of the broadest and most popular ones is consumer sentiment. They ask them things like, how do you feel about your current financial condition? And how do you feel about where you think your financial condition will be a year from now? Very broad stuff, and they hit the average household. And when you look at that data, here at the last half of 2025, consumer sentiment data have been, there's no other word for it, they've been plummeting. They've been falling off quite rapidly, and we're down in a zone once again on these data that would normally be associated with a recession if you look across to the left. In recent months here at the very end of 2025, consumer sentiment data actually hit levels that were lower than they were at the bottom of the great financial crisis. Again, are we in a financial crisis? No. Are we necessarily in a recession? No, we're not. But many of the variables in our economy are located in ranges that would normally be associated with very, very soft economic times. So the Fed is paying very close attention to all these things, and they want to do something to get activity and sentiment improved for all households, not just the top 20. So they're very intent on doing something which starts with lowering rates. And that takes us straight into the second factor. We know what's happening with households and consumers. What's happening to businesses? What's the story there? And we've had booming CapEx, lots of activity, but there is reason to believe that business sentiment and CapEx are also very concentrated within the AI space. And we're going to unpack a couple of things there to illustrate it's not just households, it's in the business space as well. I'll start out with the first one, which is capital expenditures. We've had a capital expenditure miracle this last 6 months in our economy as the AI companies have unleashed hundreds and hundreds of billions into the trillions of dollars towards projects to fund the build out of AI and the AI space. But when you take a step back and move outside of that, you see something quite a bit different. Within the box, there's an interesting fact there that over this last 3 years, as the AI boom has exploded, within the S&P 500, 90% of the CapEx growth has been from companies in the AI space. 90. That's amazing. Well, let's step away from that. What does CapEx look like for the rest of the economy, all the other businesses? This is just one of many of the surveys that are out there. This is a manufacturing survey from the East Coast. How do you feel about CapEx for the next 6 months? They ask CFOs and CEOs how they feel about it. Chart looks quite a bit like consumer sentiment. On the right-hand side, over this last couple years, CapEx intentions have been dropping and dropping and dropping. That does not mean these companies are in distress. They're making money. They have reserves, but the uncertainty of everything that is going on has the average CEO, CFO sitting on their hands and not looking too willing to make major investments. And if you think about it, CapEx investments expand businesses, they create job opportunities, they create payroll growth, they create earnings growth, and they help the average household feel better and spend more. Fed wants to stimulate this too, and that's one of their other reasons for moving towards lower rates. And when you look down into one of the most important industries, you get more data that supports this thesis, right, Dan?
Well, right. And so, I mean, the previous chart talked about CapEx intentions for manufacturers, which is a smaller component of the U.S. economy than it used to be. But, again, one of the tailwinds that we're expecting to see some activity from is OB3 that really has large tax incentives for expansion of manufacturing capacity inside the United States. When we look at transportation, right, so this is the movement of real goods, right? We don't have widgets or we don't have anything show up in a store without it hitting a truck, a ship, or a train. But as our data regarding TSA check-ins showed, the movement of people is increasing. So human capital is flowing, but maybe physical capital is not flowing as much as it may have in the past. It's a little bit of a mixed signal, not necessarily a gross negative, but certainly inside trade is being challenged.
Yeah, transportation's a big one because almost everything we consume has come on a truck or a train or something. and that activity looks pretty slow. So this all supports the Fed thesis that they need to do something to get the average business, average consumer moving. That's why they're on the path that they're on. This takes us naturally to the final K factor. What else is K-shaped out there? Well, the public markets are, the equity markets are. We know what's going on inside business. Earnings and market returns are both concentrated in the AI space. It has impacted the stock market, and there's definitely a K-shaped phenomenon that's happened within particularly the S&P 500. And so Dan has a number of charts to take us through and illustrate what's going on there. Take it away, Dan.
Sure. I mean, when you look at the 483 mainline companies other than the 17 that are AI related inside the S&P 500, you don't see the spectacular results that you see headline for the index. And that is because the vast majority of the earnings growth, the capital expenditure, and therefore the price return has come from these 17 companies. The thing that sort of tends to bring out in people is, well, the last time we saw a whole bunch of technology companies sort of leading the pack, we know how that movie ended. We would say that the difference between then and now is pretty stark. So if you look at the operating margin of the largest tech companies today versus in 2000, they're much more profitable. As a result, you get a much higher return on equity, which is a key selection factor as we focus on quality in equity selection. And most importantly, the forward PE, or the valuation of those companies today, while elevated against recent history, is nothing like it was when we were producing predominantly Super Bowl ads and puppets. The issue with this is we definitely see elevated valuations today against our recent history, but we don't think that's cause for extreme concern, right? So we say it's not causing us vertigo, even though we might be higher than normal, and that's because of this value, or the quality of these earnings. It's being funded with cash, with earnings or operations of the company, not with debt. So we consider the higher valuations, and then in the context of the macro environment, do we expect this to be sustainable? And with the Federal Reserve being at least on the balance dovish, we're cutting rates yesterday, and then having a forward guidance that is maybe mostly holding steady, but certainly downward tilted, that's a net good and will eventually make its way through the economy. Certainly the fiscal policy, right? So we saw deficit spending, which is not good long-term, certainly not as a citizen, but as a business being the beneficiary of that spending, that's certainly a tailwind. Trade policy is maybe coming off of a headwind. We thought it was going to be catastrophic, and maybe finding out that there may be some sense coming to how that's going to actually work. But the final is deregulation, which has really been not hitting on all cylinders and is yet to come. When we put all of that together, we think about what does the forward market return look like, or at least for next year, and it's really quite rosy. So we take a framework of what do we think earnings should be on a price per share against the S&P 500, and what do we value those earnings as the most simple way of thinking about what the forward path looks like. And if we take the current valuation and a conservative estimate of earnings growth, we get to these green boxes, which gives us, call it 7 to 20%, if we get a reasonably placid valuation market or valuation environment. And in fact, the forward estimate for consensus earnings is actually 14%. So we're, even if we just get half of consensus earnings growth combined with at least a flat valuation, given the tailwinds that we're seeing, potentially a positive valuation environment, it's sort of lining up for a reasonably positive year.
Yeah, and I said to somebody the other day, it's with the incredible returns we had in 2023, 2024, and again in 2025, it's sometimes hard to be optimistic looking out into next year, but a 7% earnings growth number is exceptionally conservative.
Yeah.
The street's at 14, we cut that in half. So if we're even directionally correct, we could expect high single digit, maybe even double digit returns for next year. Not to say there are no risks. We're not saying that at all. There are plenty of risks out there. We just think the base case tilts towards the optimistic side. Well, what are the risks? There are certainly risks. There are always risks, but in 2026, the one on the left, inflation is probably the primary one. The inflation numbers, we're in a unique period of time with the tariff program, 100 years since we've done an experiment like this. If the inflation numbers move up higher than expected, I said before they're around 3, and the world expects they could go to 3.2 or 3.3, something like that. If in fact the tariffs all come online and inflation numbers move up to 3.5 or 6 or 7, that would be a very large surprise to the Fed and to the markets. Also, if inflation goes up to 3.3 as expected, but does not naturally come back down. Remember, the Fed is moving rates lower, which is stimulative. So if the inflation numbers do not come back down, the Fed will not be able to move rates lower. They might even have to talk about increasing rates. That would change the narrative, and that would probably bring some market volatility with it. We don't think that's the base case outcome, but that's the biggest risk. Geopolitical tension is always a risk. There will never be a forecast, probably in my lifetime, where we would say that geopolitical tension is not a potential risk. Conflict seems to come quite regularly these days, but we've pointed out in many, many times to our clients, geopolitical risk tends to have a very, very short-term impact on both the economy and markets. They tend to have very limited global economic impact and short-term impact on the markets. So we don't tend to react to geopolitical risk. It could always happen, though. We could have some dark days. We never know when that might happen. On the right-hand side, what if AI is just not as productive as we hope? We have this AI boom, this AI build out is happening, billions and billions and billions of dollars being piled into it that's helping our economy a lot. We may find out that AI is not going to be as productive as hoped. That's not a 2026 or maybe even a 2027 risk. The build out is just underway. We're assembling the backbone, the picks and axes stage. We will find that out further down the road. And if 2 or 3 years from now we find out it's not nearly as productive, yes, that could be a challenge to many narratives. But certainly not in 2026 is that likely to show up as a major risk. And the last one, which is Dan's favorite one that he wanted to add, is there is always a risk that the aliens come and take us all away. Or do something worse than that. We are not forecasting that. We do not have an alien hedge play in place at this point in time, but Dan is always working on it.
Sure. I mean, the problem is that we found out not too long ago the Air Force told us that they're there. They just haven't landed yet. So
they're really there.
You know, hopefully they continue to fly.
We never know on that one, folks. We can't help you there. Another big wild card we have is pretty simple. It's just longer term rates. This is a chart of the 10-year Treasury rate. And you can see on the right-hand side during this last half of 2025, really close to the end of the year here, the 10-year Treasury rate really hasn't moved. Today when we're recording this, I think it's at 4.15 or 4.16. So as the Fed has moved rates lower and talked about continuing to move them lower, longer-term rates have not responded. That is a challenge. The Fed needs this long-term rate and the 5-year Treasury rate to fall if their program is to be as effective as they need it to be. The average household needs the 10-year Treasury to fall so that mortgage rates can fall. The average business owner wants to see 5-year Treasury rates fall so that term business borrowing rates can fall. That has not happened. In fact, since the very beginning of the Fed easing campaign, the 5 and 10-year Treasury rates are actually higher than when the Fed started the easing campaign. So this is a little bit of a wild card heading into next year. If it stays stuck here above 4%, that will not be good for the administration or the Fed. If we are 3 or 4 or 5 months into 2026 and the Fed has moved again and the 10-year is above 4, we probably will start to hear rumblings of some type of government intervention to move longer-term rates down. You'd be talking about quantitative easing, which would make a lot of people unhappy and would spark some debate, but that's a very real possibility as we go into next year. And of course, here at the end of 2025, constant You and I are getting beat about the head and shoulders quite a bit about private credit right now. This question is going to be around for a while. What do you think there, Dan?
Sure. It's easy to point to a reasonably opaque and arcane market such as private credit and look at a chart like the one on the right that you see it going from $500 billion to $2.25 trillion in just over a decade and say, there's got to be something wrong here. The thing that I think a lot of people miss is that a big tailwind for private credit was the national regulator of banks, the OCC, provided guidance that took banks out of a lot of the lending that private markets lenders are currently involved with. So, in fact, we just got updated guidance this week that will allow banks to re-enter this market. And the key here is that the way that you lose money lending money is either you have to have a default, right? So that's generally going to be a condition where you're in a recession or things are really not going well, people will default. But then the other way that you have losses in credit is when you can't get refunded for the debt that you carry. And so the old saying, a rolling loan gathers no loss is one that condition is not met here. On the left, you see a whole bunch of dry powder, which is commitments or callable capital available to these private market lenders. It's about 25% of the outstanding AUM or debt that's in the space already. And then with the re-entry of banks into the space, it's got to be positive for the underlying lender or the underlying borrowers, which are generally operating companies that need direct capital for growth, likely to see spreads come down even if rates aren't as aggressive as we might like to see. It's hard to see where this blows up, at least in 2026.
Yeah, you're making a great point, Dan, that I think a lot of people don't maybe connect with really well. It's always usually triggered by a liquidity crisis.
Right.
That's normally what causes it. And what you're showing us is on the left, there's $600 billion of dry powder liquidity in the private credit space already. And on the right, the banking industry is now going to be allowed back into what's up to $1 trillion of lending that could be done over the next year. And it dramatically lowers the likelihood that you run into a liquidity crisis in the next 12 months.
Absent a recession, it's really hard to see where you're going to get a source of losses here.
Okay, we're not saying that this isn't rose-colored glasses.
Right, yeah.
It's not rose-colored glasses. That we know that there are risks building anytime it grows like this, but we're watching it very closely, and we don't think it's a primary driver in 2026. So to summarize everything, this is our table that tells you all the things that we just talked about regarding the economy and the markets. Real GDP is our economic growth rate. On the right-hand side in the dark box for 2026, we do think we'll have a soft patch first half of the year in 1.567 range, but probably if the Fed is able to keep lowering rates, the economy moving back up to a steady, hopefully broad, stable 2% growth rate that includes all the companies and all the households. Inflation, we are going with the academic belief on this that inflation could move up to 3.1 or 2, but that it will be moving down during the second half of 2026, not at the Fed target, but falling from the 3% range towards the Fed target. That's the biggest risk factor in our forecast for next year. Unemployment, that's the jobs market. We know that the payroll story looks rough. We think there is something there, but we think if the Fed gets moving and corporate America gets moving, the payroll story will stabilize. Unemployment could move up to maybe 4.5, but that's a manageable number. Fed funds, we've already said we think they'll move to 3.25 by the end of 2026. 10-year Treasury, another hot point there. If it stays stuck above 4%, we will have talk of quantitative easing or something like that to try to drive those rates well below 4% to really help stimulate things. And as Dan very well illustrated, S&P 500, if everything on the top part of this forecast is correct, you should have at least 7% earnings growth, which could set us up for a 10% or better stock market return in 2026. And that would really be an incredible string of returns. We're very well aware of that. And we're going to turn to something we usually don't put up here. This is plain old statistics, regression charts, because we want to talk about the difference between short-term and longer-term outlooks and what it means for our conclusion.
Sure. I mean, anytime you're presenting a near record valuation environment and saying, hey, things are probably going to get even better, that's sort of an uncomfortable message for us as long-term practitioners to have as our forecast. And so just sort of making clear on the left, this is the 1 year return that follows given a valuation level. And the idea here is that there's effectively no relationship between the valuation that you have today and what your next year returns will be. When you start thinking about what is the longer term implication of that, you start to see a little more clustering in a relationship that is, if you're buying stuff that's very expensive and you hold it for a very long time, then your returns are going to be lower than if you buy things cheaply. So it's not to say that we think that all things are rosy and that this is an awesome thing. It's the setup for next year is one that is likely going to be positive still, and just recognizing that that is not going to be the condition always, but for next year it is.
Yeah, and charts like this don't guarantee what's going to happen over the next 1 or 3 or 5 years, but we learn from them, and what it tells us is we really have to take a step back, and it really sets us up for our recommendation for next year. Be aware of this and do some planning, right? That's the big thing, and that is how we'll finish with what does it really mean for your money heading into next year. As we have illustrated for you, we are mildly optimistic heading into 2026. We think things will probably work out in a beneficial fashion. The Fed is going to do their best to orchestrate a smooth transition, and by that we mean a transition from a concentrated economy that might go through a soft patch to a broader, more stable economic growth pattern around 2%. But of course, there are risks, there always are, and there are meaningful risks in 2026. We are not ready to overweight risk yet, and by that we mean overweight equities. That's how we would say that within a portfolio construction context. We are fully allocated to equities. We have a neutral allocation right now. We're not overweight, and what that means, if you have a 50-50 portfolio target, 50% equities and 50% fixed income and cash, we are recommending being right at your allocation of 50%, whatever that is. If you're at 70, we have you at 70. So not overweight, but fully exposed, because we do think next year could be profitable. And of course, Dan, the last point, which you just hinted at, the most important one of all.
Right. So I mean, asset allocation is the key determinant of your future returns and of your success against your goals. The chart that we showed just prior, where forward returns are likely to be lower, we want to make sure that you're thinking about, do you need to take the risk that you're currently taking in order to make those goals happen? So again, back to planning, as Eric talked about, if you don't need to take the risk, then maybe you shouldn't, but making sure that your risk is not just how market participants tend to think about it, which is solely volatility, but what is the risk to your financial goals, or what are the outcomes that you seek?
Yeah, excellent point. And the most important point of all, this is it. Time to revisit those goals. Get together with your wealth advisor and your team. Think about those long-term goals and what it means for you heading into next year. Absolutely the best way to close. And that's where we'll finish, right there. So thank you very much. We want to say thank you to you all. If you are a UMB customer, thank you for going on this journey with us. If you're a prospect, we would love to help you out in your financial journey over the next few years. Thank you all for joining us today, and we're looking forward to a wonderful 2026.